There are numerous investment opportunities here. If you miss out, you might have to wait another 10 years. I can provide you with an investment outlook, where one leading company could potentially multiply its value several times, even tenfold. Check out my profile for more details, and add my account to inquire. It's truly unprecedented. Global financial markets crashed. On August the 2nd alone, the US stock market plummeted by 2.43%, European stocks by 2.67%, and Japanese stocks by a whopping 5.81%. And long-depressed oil prices suddenly dropped by 2.46% overnight. Even gold, traditionally stable, took a sudden turn during trading, starting with a 1.2% rise, and ending with a 0.1% drop. Yet amidst all this turmoil, the Renminbi defied odds and surged against the US dollar, appreciating by a remarkable 900 basis points, a whopping 1.18%. It jumped from 7.25 to 7.16 yuan per US dollar. A lightning-fast rise in the currency market. What's more critical is the current 4% interest rate differential between the US dollar and Renminbi. Ever wondered how much capital is naturally inclined to flow from Renminbi to US dollars to earn that extra 4% annually? In this scenario, the Renminbi still managed to swiftly rise, akin to sprinting 100 meters in a storm. So, what exactly happened? Most people have no clue. There's a significant global financial indicator called the Panic Index. On August the 2nd, this index skyrocketed to 50%, indicating extreme panic among global investors. Why such panic? Just a day earlier, global markets faced two major blows. Firstly, the US released crucial economic data on August the 1st, revealing a significant contraction in 86% of domestic industrial enterprises, hitting record lows in orders and production indices. Compounding this, costs such as shipping and energy continued to rise, squeezing US industrial profits. Secondly, the UK, home to the world's second-largest financial center, and the sixth-largest economy, was on the brink of bankruptcy, over a mere £22 billion fiscal deficit. The response on August the 1st was to unexpectedly cut the pound's benchmark interest rate from 5.25% to 5%. On the surface, it seemed like the pound couldn't hold up with high rates, but it actually reflected the impending strain on the US dollar. Despite the US dollar's announcement on July the 31st that there would be no interest rate cuts in August, the internal damage had already been severe. Bankruptcies among US domestic industrial enterprises, bankruptcies among local banks, and rising default rates on US residents' credit cards were all increasing rapidly. However, given the US dollar's immense size, premature interest rate cuts without achieving set targets would mean completely rewriting existing global financial rules. Hence, they didn't hesitate to send a friend to take the first step and test the waters. But here's the issue: global investors were panicking, so logically, they should have flooded into gold for safe haven. Yet why did gold not rise while the Renminbi surged? It's because amidst these two major blows, there were precisely two reassuring factors. The first reassuring factor: recently, heavyweight US entrepreneurs participated in a forum in Beijing. Just naming a few, you can feel how strong the lineup is. Top global investment bank Goldman Sachs, top global aircraft manufacturer Boeing, global semiconductor giant Qualcomm, global chain giant Starbucks, global electrical giant Honeywell. These are multinational corporations that have no fixed headquarters. They settle wherever they can provide a stable business environment. No comparison, no harm. Not only are borrowing interest rates high in Europe and America, but the supply of energy and electricity is also unstable. Paris experienced power outages during the Olympics. Tesla's factory in Berlin stops production every few days. The key is the uneven industrial output. A large number of components need to be imported. On the contrary, look at China. New energy generation accounts for more than 40% of the total power generation, and installed capacity accounts for more than half. The degree of energy supply's dependence on oil imports has greatly weakened. In June, oil imports dropped by 10.7%. China's domestic industrial enterprises don't need to worry about power outages at all. More importantly, China has just changed its energy consumption restrictions to carbon emission limits, which is conducive to expanding production. This is not a safe haven for global manufacturing, but the home of global manufacturing. The second reassuring factor: China's oil imports have significantly decreased, but the oil giants are more determined to cooperate with the country. On August the 1st, the Saudi Financial Fund and 6 Chinese financial institutions signed agreements totaling $50 billion, focusing on deep investment cooperation, particularly in new energy. For example, in Saudi Arabia, where the world's largest new energy storage facility and solar power station are under construction. Do you know what this means? It means that even the oil giants clearly see that China's green electricity will sooner or later replace oil as the world's firm energy foundation. On the one hand, there are two major blows. On the other hand, there are two major reassurances. If you were global funds, would you choose to stick with Renminbi?